Most people think mortgage protection life insurance is only for people who already bought a house, but that's not true. And honestly, a lot of families find out too late why this coverage matters. I'm Fred Levi with Fred Levi Financial, and today I want to break down what mortgage protection really is, how it works, and why it may be one of the smartest financial decisions you make for your family. Now, first, let's clear something up. Mortgage protection doesn't always mean you need $1 million policy. A lot of people hear life insurance and immediately think they need enough coverage to completely pay off their entire mortgage balance. But in reality, that's not always necessary. Sometimes the goal isn't paying off the whole house. Sometimes the goal is simply buying your family time. Because think about it, if something happened to you tomorrow, would your family be able to keep making the mortgage payment next month? What about 6 months from now? What about a year from now? For many families, the biggest fear isn't the mortgage itself, it's losing income. That's why some people choose to structure coverage to protect 12 to 24 months of mortgage payments instead of trying to cover the entire loan balance. And honestly, that strategy can make a lot of sense. Let's say your mortgage payment is $3,000 a month. Instead of needing a massive policy to pay off a $500,000 mortgage, you might choose coverage that provides enough money to cover 2 years of payments. That gives your spouse or family breathing room, time to grieve, time to adjust financially, time to sell the home if needed without being forced into foreclosure or panic decisions, time to figure out the next step. And a lot of people don't realize this. Mortgage protection can also help if you don't currently own a home yet. Maybe you're planning to buy a house in the future. Maybe you're a young family trying to prepare early. Maybe you're finally getting your finances together and building toward home ownership. Getting coverage before you buy a home can sometimes be smarter because you may qualify younger, healthier, and potentially at a lower cost. A lot can change in just a few years. Health changes, jobs change, life changes, and once health issues show up, insurance gets more expensive or sometimes unavailable altogether. That's why planning early matters. Another thing people don't realize is this: mortgage protection isn't only about death benefits. Some policies may also include living benefits depending on the coverage, meaning if you experience a serious illness, disability, or qualifying medical condition, there may be options to access benefits while you're still alive. That's important because life doesn't only hit families after death. Sometimes the financial pressure starts after someone gets sick, misses work, or loses income unexpectedly. And one of the biggest misconceptions I hear is, Fred, I'll wait until after I buy the house. But the truth is, the best time to explore options is before the emergency happens, not during it. Because once stress hits, that's when people realize how expensive life can become very fast. At Fred Levi Financial, we believe protection should fit your real life situation. Not everybody needs the same policy. Not everybody needs maximum coverage. Some people want enough to pay off the home. Some people only want enough to protect monthly payments for a period of time. Some people want coverage mainly to protect their children and spouse from financial pressure. And that's okay. The goal is creating a plan that gives your family stability when life becomes unpredictable. Because at the end of the day, mortgage protection isn't really about the house, it's about the people living inside of it. If you want to explore your options, get education on how this works, or see what may fit your budget and goals, reach out to Fred Levi Financial. We'd be happy to help you understand your options with no pressure, because protecting your family financially should never be something you put off until it's too late. Mortgage protection policies can help cover remaining mortgage balances or temporary mortgage payments after death, disability, or other covered hardships, depending on the policy structure. Some plans are specifically designed around 12 to 24 months of mortgage payment protection rather than full payoff coverage.